This is the only video you need to watch if you want to understand everything about how tax deductions work. In case you don't know me, it's your friendly neighborhood taxman. My name's Davie Mack. I am a chartered accountant and I run Box Advisory Services. I have over 17 years experience working with over 2,000 small businesses, and I've heard it all.
My mate, John, claims it all back on taxes.
Susie's accountant lets her deduct all this in taxes.
And yes, the ATO is generous with its tax deductions, but you need to understand how to best leverage it for your situation, not John and Susie's. And to do that, we need to go back to the basics. So in this video, I'll show you how income tax works, what tax deductions are, how your business structure affects how much tax you pay. We go through examples on each one and the difference between tax planning and evasion, so you don't get yourself into trouble with the tax office. Ready to jump in? Let's start with a crash course on how tax works. In Australia, we have what's called a progressive tax system. This means the tax rate increases as your income increases. These rates are also marginal, which means you only pay the higher rate on the portion of income that falls into that bracket. These are the individual tax rates. So if you're earning $100,000 as an individual or a sole trader, you'll pay $0 on the first $18,200, 16% on the income between $18,201 to $45,000, which in this case $4,288, 30% on the rest up to $100,000, which is in this case $16,500. So your total tax would be $20,788. But different business structures are taxed differently. For example, all companies pay a flat tax rate. So it doesn't really matter what income bracket you are in, you still pay the same flat tax rate. For small to medium businesses, the flat rate is 25%. This is the most common tax rate for companies in Australia. For larger companies, the flat tax rate is 30%. This means the same $100,000 profit would end up as $20,788 tax for an individual or a sole trader, $25,000 tax for a small or medium-sized business, $30,000 tax for a larger company. Got it? Does it make sense? Let's move on to why you're really here. Tax deductions. And I'm gonna address the elephant in the room right away. Claiming a tax deduction does not mean you'll get the entire cost back in the tax office when you lodge your tax return. So if you're buying a $25,000 work car, the ATO isn't gonna go, hey man, here's $25,000 back for the company car that you purchased. You pay a lot of tax and you deserve it. Instead, let me explain how they really work with the ATO. Basically, you can claim a tax deduction for the majority of the expenses you incur running your business. These tax deductions reduce your income, which means you only get part of the cost back for deductible items. So that leads to the question, how much can you get back for your business expenses and what constitutes as a work-related expense in the first place? Generally, you can claim a deduction on the following: operating expenses like business travel expenses, rent, insurance, office and home office expenses in the same year you pay for them, and capital expenses like equipment and machinery over a long period unless the business uses the small business asset write-off under $20,000, which I won't get into much detail, but the best way to explain the tax deduction is to show you. For this example, I'll use the company flat tax rate of 25%. So let's say ABC business earns $110,000 and retains a business profit of $110,000. The business has already paid PAYG income tax of $20,000. So based on these figures, you owe the ATO $7,500. That's without any tax deductions. Now let's look at what you would owe the ATO with tax deductions. So let's say ABC business earns $110,000 and retains a business profit of $100,000. $10,000 of which are direct result of operating and capital expenses that can be tax deductible for the business, such as purchase of a new equipment. Look at the breakdown now. You're actually reducing your payable by $2,500. That is 25% of $10,000. But you can also see that the $10,000 tax deduction saved you $2,500 in taxes, not $10,000. So this is why I always say don't spend money just to get a tax deduction. You're still out of pocket for the most of that expense. But besides explaining how tax deductions work, I also wanted to show you why your business structure impacts all of this. Here's another crash course for you. There are 4 common structures, 2 of which I've mentioned earlier: sole traders and companies. And then the other 2 are partnerships and trusts. If you're a sole trader, you and your business are the same entity for tax purposes. You report report your business income on your personal tax return and pay taxes at your individual tax rates. Partnerships are similar in that the partnership itself doesn't pay tax. Instead, each partner reports their share of the partnership income on their individual tax return. Deductions work similarly to sole traders but split between partners based on their agreement. Companies pay a flat tax rate, as I mentioned earlier, because they are a separate legal entity. So deductions reduce the company's taxable income, not yours personally. This means the tax savings are always flat, regardless of how much the company earns. And then there are trusts, which are the most complex I've ever seen in my life. The trust itself doesn't usually pay tax. Instead, the beneficiaries pay tax on their share of the trust's income. Deductions in a trust can be distributed to beneficiaries along with the income, potentially allowing for some tax planning opportunities. So why does this actually matter? Let's go back to the example of $10,000 in deductions. As a sole trader earning $100,000, those deductions could save you $3,000 in taxes at the 30% marginal tax rate. For a small company, the same deductions would save you $2,500 at 25% company tax rate. In a trust, you might be able to distribute the profits and the deductions to a beneficiary with a tax rate that will help you maximize the deduction. So it really depends on what the tax rate is for that beneficiary. So there is an element of tax planning within your business structure so that you are able to maximize your tax position. It is easy to see that if you think you're going to earn over $180,000 in profits after tax deductions as a sole trader, you'll get taxed more due to the higher tax rate of 45%, whereas a company has a flat tax rate of only 25%. That's almost $10,000 in tax savings. The larger the profit, the bigger the tax savings. Of course, just like you shouldn't spend money just for the sake of tax deductions, you should also not choose your business structure solely because you would only benefit from a tax deduction perspective. There are a lot of other things to consider, which leads me to one more thing I want to touch on in this video: the fine line of tax planning and tax evasion. You have the right to arrange your financial affairs to keep your tax to a minimum. This is often referred to as tax planning or tax-effective investing. Tax planning is legitimate when you do it within the terms of the law, which takes in consideration laws about tax avoidance. So it's completely legal to choose a business structure that best suits your needs, time your income and deductions strategically, maximize your tax deductions. Tax evasion, on the other hand, is illegal. It's deliberately misreporting your income, claiming false deductions, or hiding money from the ATO. Trust me, some people do that. The line between them can be blurry, and that's where Part 4A comes in. This is a rule that defines what constitutes as a tax avoidance scheme. Basically, if the ATO thinks you're entering into a scheme with the sole or dominant purpose of getting a tax benefit, they can come after you under Part 4A. That is why those too good to be true tax schemes are too risky. So if it sounds like it's a dodgy way to avoid tax, it probably is. But let's be clear, legitimate tax planning is not tax avoidance. There's nothing wrong with claiming all your deductions you're entitled to or structuring your business in a tax-effective way. The key is to stay within the spirit of the law, and if you're unsure, always get professional advice from a registered tax agent or accountant like me. I'm gonna wrap this up here, but if you're looking for more insight on specific business structures or how that impacts your overall tax, I recently published a video which specifically talks about companies and trusts, so go check it out. See you guys next time. Bye.